Hey, Dividend Stockpile family. Welcome back to the channel. Today we have an exciting and detailed comparison lined up for you. We are going to deep dive into the differences and similarities between four popular ETFs: JEPI, JEPQ, SPYI, and QQQI. These funds have been gaining a lot of attention lately, and it's time to break them down so you can make informed investment decisions. So let's get started. First, let's briefly introduce these ETFs. JEPI is the JP Morgan Equity Premium Income ETF. JEPQ is the JP Morgan Nasdaq Equity Premium ETF. SPYI is the NEOS S&P 500 High Income ETF, and QQQI is the NEOS Nasdaq 100 High Income ETF. These ETFs aim to provide income and growth potential by investing in equities and using option strategies. But how do they differ? And what do they have in common? Let's find out. Let's start with the investment strategy. All four ETFs utilize an options overlay strategy to generate income, but they do have different focuses. JEPI invests in a diversified portfolio of U.S. large cap stocks and uses covered call options to enhance income. The focus is on high quality, low volatility stocks to provide stable income stream. JEPQ, similar to JEPI, focuses specifically on stocks in the Nasdaq 100 index, combining growth potential with income from options. The tech-heavy composition offers higher growth, but also higher volatility. SPYI invests in S&P 500 stocks and uses a combination of covered calls and put spreads to generate income while aiming to reduce downside risk. The approach is more defensive, focusing on capital preservation along with income. And QQQI targets a Nasdaq 100 index with an options overlay strategy similar to SPYI, aiming for high income and reduced volatility. It combines covered calls with put spreads to manage risk and enhance returns. As you can see, JEPI and JEPQ are from JP Morgan and use ELNs to simulate covered calls. SPYI and QQQI from NEOS have a more complex option strategy involving both calls and puts. The choice of the underlying index, the S&P 500 for JEPI and SPYI, and the Nasdaq 100 for JEPQ and QQQI, also significantly impacts the risk and return profile. Now let's talk about dividend yield. This is a key factor for many income-focused investors. JEPI is known for its attractive yield, often ranging between 6 and 8% a year. This high yield is a result of the income generated from the covered call strategy and the dividends from the underlying stocks. JEPQ offers a competitive yield, though a little higher than JEPI, typically around 8 to 10%. The tech-heavy focus can lead to higher capital gains and a higher yield compared to JEPI. SPYI provides a yield that has outperformed JEPI, usually in the 10 to 12% range. The use of put spreads can help maintain a higher yield while managing risk. QQQI also targets a high yield, often between 12 and 14%. Similar to JEPQ, the tech focus can lead to variability in yield based on the market conditions. All four ETFs aim to provide substantial income, but SPYI and QQQI often lead the pack with their higher yields. The choice between them may come down to your preference for the underlying index and risk tolerance. Speaking of risk and volatility are important considerations, especially when dealing with option strategies. JEPI offers lower volatility due to its diversified large cap portfolio and conservative covered call strategy. The focus on high quality, low volatility stocks helps to cushion against market fluctuations. JEPQ offers higher volatility compared to JEPI, reflecting the tech-heavy Nasdaq 100 exposure. While this can lead to higher returns, it also means more risk during market downturns. SPYI aims to reduce volatility through its option strategy, balancing income with downside protection. The use of put spreads helps to mitigate risk associated with market drops. QQQI is similar to JEPQ in terms of higher volatility due to its Nasdaq 100 focus, but with some mitigation from its option strategy. The combination of covered calls and put spreads can help manage the risk. JEPI tends to have the lowest volatility, making it suitable for conservative investors, while JEPQ and QQQI cater to those willing to take on more risk for higher growth potential. SPYI offers a balanced approach with risk management through its options strategy. Now, performance is where things get interesting, so let's compare their historical returns. JEPI has offered steady performance with consistent income and moderate growth. The focus on high-quality, low-volatility stocks contributes to stable but lower returns. JEPQ has a higher potential returns during the tech booms, but also higher risk. The tech-heavy Nasdaq 100 can lead to significant growth during bull markets. SPYI balances growth with income, showing resilience in down markets. The defensive option strategy helps to protect against significant losses. And QQQI has strong performance during tech rallies, similar to JEPQ, but with additional income strategies. The options overlay can enhance returns while managing risk. Each ETF has its strengths, with JEPI and SPYI offering more stability, with JEPQ and QQQI provide higher growth potential with greater risk. Your choice will depend on your investment goals and risk tolerance. Expense ratios are crucial because they impact your overall returns. JEPI and JEPQ have an expense ratio of around 0.35% a year. While this is higher than some passive ETFs, it's reasonable for an actively managed fund with a covered call strategy. SPYI and QQQI have a higher but still competitive expense ratio of about 0.68%. Their use of multiple option strategies is managed efficiently to keep your costs low, but it does cost more to run the fund, so the higher cost is justified. JEPI and JEPQ offer lower expense ratios, making them more cost-effective options compared to SPYI and QQQI. However, the slightly higher cost of SPYI and QQQI can be justified by their income generation and growth potential. Tax efficiency is another important aspect to consider. JEPIs, the dividends associated with that, are typically taxed as long-term capital gains, but the covered call premiums are usually considered short-term capital gains for tax purposes. JEPQ has similar tax treatment to JEPI, with a mix of ordinary income and potentially more favorable long-term capital gains from the dividend strategies. While many Nasdaq 100 stocks do pay dividends, they typically are lower yields than the S&P 500 companies, so you're going to have more of your income coming from the option strategy than from dividends in the JEPQ ETF. SPYI uses put spreads and covered calls that can lead to a mix of ordinary income and capital gains, potentially offering some tax advantages. For instance, their options program uses 1256 contracts, which are taxed at 60% long-term and 40% short-term gains. They also use tax loss harvesting to reduce the taxes. Similar for QQQI is similar to SPYI, with the tax treatment depending on the mix of dividends, options premiums, and capital gains. Understanding the tax implications of each ETF can help you optimize your after-tax returns. But of course, consult with a tax advisor to make most of these strategies. Now let's dive into the holdings and sector exposure of these ETFs. JEPI offers diversified accounts through various sectors with a focus on high-quality, low-volatility, large-cap stocks. JEPQ is concentrated on the tech-heavy Nasdaq 100, leading to significant exposure to technology and consumer discretionary sectors. SPYI offers broad exposure to the S&P 500, providing diversification across multiple sectors. And QQQI is similar to JEPQ, with a focus on the Nasdaq 100 and significant tech exposure. The sector exposure of each ETF can impact performance and risk. JEPI and SPYI offer broader diversification, while JEPQ and QQQI provide targeted exposure to high-growth tech stocks. Finally, let's discuss which investors might prefer each ETF. JEPI is ideal for conservative investors seeking steady income with lower volatility. The focus on high-quality stocks and covered calls makes it a reliable choice for income generation. JEPQ is suitable for those looking for a balance between income and tech-driven growth. The higher volatility and growth potential appeal to investors with a higher risk tolerance. SPYI is great for investors who want a mix of income, growth, and risk management. The defensive option strategy provides a balanced approach. And QQQI is perfect for those willing to embrace tech volatility for higher income and potential returns. The combination of high yield and growth potential suits aggressive investors. Understanding your risk tolerance and investment goals is key to choosing the right ETF for your portfolio. Whether you prefer stability or are chasing growth, there's an option for you. So there you have it, an in-depth comparison of JEPI, JEPQ, SPYI, and QQQI. Each of these ETFs offers unique benefits and caters to different investment strategies. If you found this video helpful, please make sure to hit the like button, subscribe to Dividend Stockpile, and ring that notification bell so you never miss an update. And let me know in the comments which ETF you're most interested in and why. Thanks for watching and happy investing.